All right. Good morning, everybody. Hong Kong is down the most, nearly 2%. U.S. markets right behind that. NASDAQ being down the most at 0.5%. S&P closer to a quarter. The Dow, again, closer to a quarter. And the Russell almost flat on the morning. We're going to continue to get a lot of jobs data this week. This morning we have JOLTS. JOLTS is an easy one to remember. The way it was first described to me when I was new was the JOLTS numbers are the take this job and shove it numbers. It's the idea or the question of how easy you believe it will be if you were to lose your job to get another job. And if you were around working during the 07-08 housing crisis or financial crisis, you may remember back then, boy, when you had a job, you fought for it because you weren't quite sure if you lost it that you would find another one very easy. It was a tight labor market. That's what the job numbers are designed to reflect. That perception of the labor conditions and the availability of jobs. Throughout this whole week, we're going to be getting different job numbers. And on Friday, we get the biggie, non-farm payrolls. We do have other numbers today, ISM manufacturing, services. We're going to get data out of Australia tonight, which, I'm not one for dismissing data. I just, try to find where it has relevance. And I don't see a lot of relevance to what happens over in Australia, not on a scale with, say, what's happening in Japan or China, even in Europe. So I won't ignore it, but I wouldn't get too stressed on that one. We are continuing to see an unwind from the market's expectation of a rate cut. They're kind of pulling back on that a little bit. The consensus does seem to be that the Fed won't raise rates for this December meeting, that they're going to stay paused, and that there's certainly not much chance of a cut. So it's just going to be hold the line. So it's not the action of the Fed that they're worried about. This is the December 13th FOMC meeting. It's what's the Fed going to say during that meeting? Are they officially going to announce that pause, which has ramifications behind it, historical precedent for what happens after the Fed officially announces a pause? Or are they going to continue to skip, which doesn't have the same weight? It was interesting. They were interviewing this guy from Alliance Capital or one of those firms, not one of the big three, but he said it was an interesting turn of phrase. He said the markets are fighting the Fed right now and basically telling the Fed they're going to cut while the Fed is saying we're not going to cut. So not only are they, normally you hear the phrase, well, the market doesn't believe the Fed, they don't have any credibility. It's not even about believing them. It's just straight out telling them you're going to cut. Well, that's interesting because the Fed is saying, no, we're not. We're not cutting in March. We're not cutting in May. We're not cutting. And the market is pricing in cuts. So that exuberant November that we just saw, a record-setting November, no less, was the market pricing in rate cuts next year and pulling them forward more and more as the month went on. It was in July, then it was June, and then it was May, and then it was March. They were pulling forward those rate cuts more and more. So that's where we're at. They're still pricing one in right now. 52% chance of a rate cut by March. If we continue to see them now unwind here, then we're going to see the market lower. It's the long and the short of it right there. Looking at this, they continued to price in a cut for January. You see that from yesterday, taking us from 5.25 to 500, increased by another 2%. So the market is just straight up telling the Fed, you're wrong. We'll see. It's showing ISM as more impactful than JOLTS. Take that with a grain of salt. Remember that these impact previews are just statistical measurements, right? In the past, how often has JOLTS been more volatile inducing than ISM? You know, that kind of concept. So they have it as a medium impact, but right now the job numbers are everything. So I would rank it as high as ISM. We are in Fed blackout mode, so you shouldn't see too many Fed speakers. You do get an occasional speaker, one of those non-voting members. So, you know, if you do happen to see a Fed speaker between now and December 13, it's not unheard of. But this is the time that you want to watch that Nick Tamaros guy, the Wall Street Journal. You can find him on Twitter. If the Fed wants to leak something, they'll leak it through him. And not everything he says is coming from the Fed. You know, so I've seen him post stuff that is, whatever. I you know, post things on Twitter, whatever. But if the Fed has something to say during that blackout period, that's where they're going to say it. They'll send it through him. I guess we'll come back to spot gamma later. $9:45, 10, 11, and then later tonight, data from around the world. There's our levels. So there's your SPX levels. Remember, you really just need the call wall, the volatility trigger, 0 gamma, and the put wall. These large gamma levels, I mean, again, you know, I don't ignore data, but those 4 are the keys. This is for the SPX and the ES. Just grab a screenshot. For the SPY, the NDX, and the NQ. And the QQQ. We're still inside week. This chart here on the right is a weekly chart. You can see how we're still within last week's range, but we are below the 50% mark. Looking at these on a weekly time frame, we need to close above that 50%. But this is only Tuesday, so there's plenty of time between now and Friday to close above that 50%. I did mention yesterday we could wick down below that level as long as we rally back by the end of the day. Even if we do close below that 50%, it's not exactly a strategic short at that point. It would just call in the idea of more weakness after this advance. 45.44 is the low of last week. It's the level we want to focus on right now. This is the previous week's low. It's halfway between the ADR half and the ADR full. Remember that the ADR is the average daily range. And just like it sounds, I use a 21-day ADR, a 21-day average. And all it's doing is looking back over the last market month and asking the question, what was the market's move on a day-to-day basis? How far did you go? What do you do on average? And we mark those lines out. So on a day-to-day basis, our generic expectation is we're going to go to at least one of those lines. Oftentimes we can go to both. We can hit the downside first and then the top, or the top side first and then the bottom. Our average daily range right now is 0.86. So the S&P has an average right now of moving a little more than 0.75% on the day. Now, if you split that in half, then you get about a 44% move to the upside from the open and a 44% move to the downside from the open. And the distance between those two is that ADR half. We're sitting on the 10-day moving average right now. We hit it yesterday and rallied back through it. When we started the week, we were above all of the moving averages. The 4, the 10, the 20, the 50, we were above them all. Now we've pulled back enough that we've cut through some of them. So right now we're negotiating with that 10. We're just above the volatility trigger, moving farther away from that call wall. And zero gamma is still a long ways off. So the idea is when we're above the volatility trigger, we can focus on iron condors, butterflies, things like that, but we're just barely there. So, if we were farther away, that would make more sense, but we're close enough to it that we could easily transition back and forth. So there's not a lot of weight to the idea of, expanding trades or penning trades like butterflies and iron condors. If we cut through the volatility trigger, though, and we do get below it, we do expect a greater volatility, which is movement. So we would anticipate that the average daily range will get bigger and that the candle sizes will get bigger. We'll get more movement between candle close to candle close. You can look those up, by the way. You can search for YouTube spot gamma volatility trigger or, spot gamma, zero gamma, and you will find videos on those that explain it, kind of give more context behind it. We have an MDP this morning, a missed daily pivot, because we haven't hit it. It's just like it sounds. That has weight as well. It's not my strategy. I don't trade it either, but I do use it in context of analysis. A lot of times we see the trigger for a setup. I don't trade it. I don't want that setup, but I'll use the setup for the analysis. So if it's a bullish trade trigger and I just use it in the context of, well, that's a bullish signal. This MDP, by the way, since we're missing it from below, is not a bullish signal. The volume is normal this morning. 120 is fine. There's absolutely nothing wrong with it. And in fact, it shows that we're not in a lack of volume or a lack of participation this morning. We got so much data this week that the expectation on most of the week was that we were going to see a lowered volume this week, a lower participation. And then these numbers are showing that's not true, which is good. You know, the lower volume really jacks with the trade strategies, so I'll take it. There's also no hedging this morning, so they don't seem to have much fear of the numbers at this point. Ten-day, 30-minute volume profile with a classic D shape, very sharp. We really have nothing here. Tight range, 80 points. And through the day today, as long as that 45 holds, this range is going to get even tighter. We're going to be looking at about a 60-point range, 70 points. $70 points. Well, it's tight. We are just underneath the point of control, so that now that is another restriction above us. It's not necessarily resistance. It's unfinished business. It's where the greatest amount of volume took place. Shallow area too, by the way, that's 45. If we happen to break through that zone, we can easily drop to 45.20 through an air pocket. So this one's questionable. It's been touched. So it's not exactly a VPOC, but we didn't close through it, which implies that there is perhaps maybe some unfinished business there. I think it's worth marking it out for the day. And then if we don't get anything out of it, then it didn't hurt anything. I'll get that cleaned up later. So the level is going to be 45.70 and one tick. So you can see how we hit it this morning, but we didn't close through it. Or I should say last night we hit it. Technically, it's been hit. It's done. But as a POC, it's still a level to keep. And since we didn't close through it, I want it on my chart just to see what happens if we do come back up into that level. We are yet again this morning messing with the weekly expected move low. 45.60 is the line in the sand there. Oh, that ain't right. Hold on. The bubble is hiding. Yeah, 45.61. Use a generic form of a 2 standard deviation. This isn't the true math for a real 2 standard deviation, but it gets the job done. If if we were to look for an expansion to the next deviation, that would be 45.17. Based on where we were Friday, right? Not based on where we are right now. Big difference between current dynamic expected move and static frozen expected move. Right now, the current expected move is 50. It's 50 points. It's 50 points higher and 50 points lower than our current location. At 2 standard deviation that I was just talking about is a 44.50 and 46.75. If we wanted to use a real 2 standard deviation from our current location, right? Not from where we were Friday. So 46.75 and 44.50 from our current location. That's a 2 standard deviation move. We got a 99% chance that we're going to close inside of that range, which may sound fantastic, but that's a huge range, right? That's like trying to hit a barn with a rock. Pretty sure you can do that. We're still down on the China ADRs and emerging markets. So things like a BABA, Baidu, JD, PDD, the FANGs are down. Google, Apple, Amazon, Microsoft, Tesla, Meta, AMD, Snow, NVIDIA, Netflix. On Thinkorswim, you can make a single market by using a plus sign in between each name that you do. And interestingly enough, you can do that on the indexes too. So like you can do an ES plus NASDAQ plus Russell. The FANGs are down 25.85. So a little bit of a gap down. They're sitting right in here. So still inside day at least. Gold, silver, precious metals, communications names. And for things that are up, bonds are up, but that's it. None of these others are up enough to reach the benchmark. Pot stocks are up this morning. All right, we'll take it. It's better than nothing, I guess. And they're not looking that great. So we got a kind of a decent setup. I like when we get a setup like this. So this really big candle is yesterday's candle, and we pulled back off of that high, left a big wick up there. And now we're sitting down here this morning. So that's a nice setup. You can set an alert at the close of yesterday. So if we get through that, that sets the alert, kind of gets your attention. You can take the trade there, or you can wait for it to break above the previous day's high. And that distance right there kind of gives you your time to get set up. That's a little bigger than I like, but it's not too bad. You could focus on a half back as well. So see if we could get a little weakness and fade back to that 50% mark before we get that follow through. Been a nice entry off the halfway point rather than waiting for it to get up and all the way through 750. This other stuff isn't up enough to get our attention. Seriously gapped down in FXI. The China ADRs are down 1.75%. Airlines gave it back. But really, I mean, they don't look that bad. They're struggling to keep it. Certainly, they look better than a lot of the other things we've seen this morning that was gapped down a lot worse. And, you know, I mean, it's been a fantastic run here. So kind of got to expect there's going to be a little pullback after so much movement here. Yeah, we got nothing. All we got is pot stocks. So we're going to need to get the data in this morning, see how it adjusts the numbers. Bonds are looking good though. We do have that risk parity this morning with, you know, stocks down, bonds up. So at least we have that. But we got the dollar up against near yesterday's high, looking for an inside day breakout expansion to the upside. Yields down, dollar up. That's going to cause a little bit of odd market dynamics. It's not going to be a fun trading day. Look for a change in market structure when the 10-year gets up to Friday's high or Sunday night's high. The idea here is we're looking for some sort of rejection here, right? If we are dealing with an inverse market or risk parity, bonds come up into that resistance and take a rejection, begin to fall back around the time the 10-year catches some support, begins to rally, gets through VWAP, starts pressing on that 50%. Then we have a 10-year going up with the dollar going up, and that would be some nice dynamics for the S&P to really leg down lower, S&P and NASDAQ. Otherwise, if we don't see the 10-year and the dollar moving up together, then we'd want to see the dollar do what it just did, continue moving to the downside, have the 10-year and the dollar both moving down. Bonds break through this 118 and continue to expand upward with stocks going up. So again, risk parity is dead. It's been dead. We don't want to see it necessarily today unwinding. So let's get stocks and bonds both moving in the same direction, and the 10-year and the dollar both moving in the same direction, just opposite of the stocks and bonds. This is going to be a tricky day. Definitely keep your eye on the news. Watch the clock. That's what I got for you guys. There's not even any real good stock to dig through. Everybody be